You're watching vTalkInsight, Market Drivers Daily for May 26th, 2026. Geopolitical flashpoints are keeping oil and inflation elevated, yet equities are charging ahead on AI optimism. Today we connect those tensions and what they may mean for risk pricing across energy, rates, credit, and tech leadership. Geopolitics and energy remain the key macro swing factors, but asset prices look increasingly relaxed about them. Tensions around Iran and the Strait of Hormuz are keeping oil volatile and inflation risks elevated, even as equity and FX volatility sit back near pre-conflict levels. Compared with the cautious optimism around a partial reopening that we discussed yesterday, today's picture is more conflicted. Military strikes have resumed, shipping is still disrupted, yet risk assets continue to lean on hopes of a diplomatic outcome. On the ground, the Strait of Hormuz remains the central pressure point. Renewed U.S. and Israeli strikes on Iranian vessels, Iranian engagement with U.S. drones, and mining activity underline that the route is far from secure. Blockages and uncertainty are causing long queues of vessels and significant shipping delays, threatening to push up fuel, commodity, and food prices if disruption persists. Brent has rebounded after a sharp pullback, with moves of 2 to 3% around headlines, showing how sensitive oil remains to every twist in the negotiations. These energy shocks are feeding directly into inflation and growth expectations. Persistent high oil and refined fuel prices are expected to keep headline inflation near 4%, with risk skewed toward 5% if energy stress rolls into next year. Refined products like jet fuel and LPG are already causing demand destruction in South and Southeast Asia, while gasoline above $4.50 per gallon in the U.S. is slowly eroding discretionary spending. For Europe, the outlook hinges heavily on whether Hormuz reopens soon. A prolonged closure could tip energy importers into recession and force central banks to pause or even reverse planned rate hikes. Rates markets are starting to internalize these risks in a nuanced way. Long-end bond yields face flattening pressure as growth concerns from expensive energy build, yet front-end yields may still be underpricing the risk that higher oil sustains inflation. Emerging markets show a clear split. Exporters like Brazil and Mexico have seen currencies and local rates outperform, while energy importers, including parts of emerging Europe and Asia, are grappling with FX weakness, potential rate hikes, and balance of payment stress. At the same time, implied volatility across asset classes has dropped back to low levels, making hedging against renewed geopolitical shocks relatively inexpensive. Some asset managers remain constructive on credit and risk assets, but are tactically using this cheap vol to ensure against a geopolitical surprise. The counter-argument is that diplomacy ultimately prevails. Talks between the U.S. and Iran are exploring phased agreements that could extend a ceasefire, partially reopen the strait, and allow temporary waivers on Iranian oil exports, which would add supply and support a disinflation narrative that bond markets are already flirting with. However, deep mistrust, disputes over uranium enrichment, frozen assets, and divisions between the U.S. and regional partners keep the risk of setback high. Markets may be underestimating how durable the geopolitical risk premium in energy needs to be if negotiations drag on. From here, watch the interaction between oil prices, upcoming U.S. PCE inflation data, and any tangible change in shipping flows through Hormuz. A genuine breakthrough could unlock underperforming European and cyclical equities, while renewed escalation would test today's complacent volatility levels. With that macro backdrop in mind, the next question is how much of the market's resilience now rests on the AI story. AI has become the second main anchor for the global macro narrative, offsetting some of the drag from higher energy costs. It underpins equity resilience, shapes capex and credit markets, and increasingly influences how policymakers think about productivity and inflation. Flows into AI beneficiaries are not confined to the U.S. Domestic equity inflows tied to AI capex are strong in Korea and Taiwan, and emerging market assets linked to semiconductors at data centers are trading more on secular technology demand than on traditional drivers like U.S. rates or dollar moves. On the investment side, AI-related capital expenditure keeps stepping higher. Data center and infrastructure budgets have jumped from roughly the mid-500 billion range to around $750 billion year on year, driving sustained demand for financing. Hyperscaler tech companies are issuing large volumes of bonds to fund this build-out, and hedge funds are active in selling credit protection to banks holding that exposure. The surge in issuance is fueling rapid growth in credit default swap markets tied to AI hyperscalers, with expectations for much more paper ahead. These structural funding needs, alongside persistent fiscal deficits, are seen as pushing real interest rates higher and lifting estimates of the neutral policy rate above official assumptions. In other words, AI is contributing to the higher-for-longer rates backdrop, even as it supports the growth outlook. The economic promise of AI is large, but so are the frictions. Many executives expect significant productivity gains, and AI adoption is expanding beyond core tech into utilities, industrials, financials, and logistics. Yet evidence on actual efficiency improvements is mixed. Some implementations are failing to deliver meaningful gains, and commentary from major technology firms indicates that in certain cases the operational cost of AI can exceed the cost of human labor. This uncertainty is feeding a wider debate about the labor market. There are warnings of a white-collar recession, particularly for entry-level roles, and concerns about job security and human capital, even as other voices argue that fears of an AI-driven economic apocalypse are overstated and current labor softness owes more to demographics than automation. At the enterprise level, adoption is shifting from fear of missing out toward fear of costly mistakes. Large customers are increasingly demanding robust security, controls, and data governance before deploying AI at scale, which is slowing rollouts, but favoring vendors with stronger safeguards. Regulation remains a major swing factor. In the U.S., the lack of a clear oversight framework leaves firms navigating a patchwork of legal and reputational constraints, while in China new restrictions on overseas travel for top AI professionals and tighter controls on strategic technology are intensifying the geopolitical dimension of the AI race. These moves highlight that AI is now firmly embedded in U.S.-China competition and globalization trends, raising the risk of fragmented innovation ecosystems and more complex supply chains. Market structure around AI is equally nuanced. Companies with near monopoly positions and persistent hardware shortages, such as in high-end GPUs and memory, are enjoying very high margins, while a broader universe of AI-adjacent names faces elevated short interest and high borrowing costs. Securities lending revenues have jumped, with AI and infrastructure-related equities prominent, showing that alongside the long AI trade, there's a robust cohort betting against some of the hype. Relying on AI-driven productivity to deliver rapid disinflation is therefore risky. If inflation proves sticky while policymakers wait for AI efficiencies to materialize, the risk of a policy mistake increases. Key watch points now include upcoming earnings from AI-exposed names such as HP, Snowflake, and Synopsys, progress on high-profile AI IPO plans, and any concrete regulatory shifts. All of this feeds into the equity leadership story, where tech and AI-related stocks continue to dominate index performance. Technology leadership remains the defining feature of global equity markets. Major U.S. indices are pressing new highs, with the S&P 500 buoyed by strong chipmaker performance and solid consumer confidence data. Semiconductors are the clear engine of this move. They have driven well over half of the year-to-date rally, turning key names into high beta drivers for the broader indices. Micron stands out, with margins swinging from negative territory to extremely high levels as AI-related memory demand overwhelms available supply, and analysts sharply raise price targets and valuation assumptions. Under the surface, the rally is broader than a single stock but still concentrated in specific themes. Technology and semiconductor gains are being joined by strength in small caps and select cyclical names, while U.S. capital markets continue to attract global wealth on the back of innovation and productivity narratives. Asia is increasingly part of the story. Chinese chipmakers and other semiconductor stocks are rallying on optimism around domestic breakthroughs, and Taiwan's equity market capitalization has surged past India's, propelled by demand for advanced foundry and AI hardware. At the same time, new computing platforms are emerging. Smart glasses initiatives, such as Warby Parker's collaboration with leading tech firms, aim to make AI-driven eyewear a mainstream interface over the coming decade, reinforcing the sense that the current tech cycle extends well beyond traditional PCs and phones. However, the rally is not without tension. Certain pockets, especially in memory chips and AI-labeled infrastructure plays, look frothy, with episodes of triple-digit price gains in short periods followed by rising short interest and high borrow fees. Software paints a contrasting picture. Concerns about the durability of the software as a service model in an AI world have driven a sharp derating in multiples. High-profile names have seen sizable drawdowns, and investors are watching upcoming SaaS earnings closely for evidence that AI can re-accelerate growth. Higher bond yields add another layer of risk by challenging equity valuations and offering competition from fixed income, although AI-related leaders may prove more resilient than the broader market if earnings momentum stays strong. From a portfolio perspective, concentration is the key theme. A relatively narrow group of tech and semiconductor names has an outsized influence on global equity benchmarks, amplifying both upside and downside if sentiment around AI or rate shifts. At the same time, the overall year-to-date return profile is not extreme by historical standards, which tempers arguments that the entire market is in bubble territory. What happens next will likely hinge on three catalysts. First, whether earnings for chip makers and hyperscalers continue to beat already elevated expectations. Second, how software and other lagging tech subsectors respond to AI, both in fundamentals and in valuations. And third, whether any escalation in geopolitical or energy stress forces a rotation away from high beta tech leadership. For now, the tech-led rally remains intact, but heavily dependent on continued AI momentum and a contained geopolitical backdrop. To wrap up, today's cross-asset picture shows a widening gap between stubborn geopolitical and energy risks on one side and an AI-powered tech rally on the other. Oil, inflation, and growth paths still hinge on fragile negotiations in the Strait of Hormuz, even as low implied volatility keeps hedging relatively cheap. At the same time, AI is driving massive capex and credit issuance, reshaping labor and regulatory debates, and concentrating equity leadership in a narrow set of semiconductor and platform names. The durability of this backdrop will depend on how quickly energy risks resolve, whether AI delivers on its productivity promise, and how valuations respond if bond yields or earnings surprise. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.